Welcome to Chapter 15, the Statement of Cash Flows. And this is arguably the most important financial statement in my opinion, because it doesn't just look at our revenue, but it looks at actual cash. If we have lots of sales that are made on credit, lots of accounts receivable, our sales revenue could be really high, but we don't have actual money to necessarily pay our bills. So we track the actual inflows and outflows of cash to ensure that we actually have enough money in order to meet the company's immediate needs, as well as do things like pay a dividend if we choose to do that, or look toward an expansion. We use the statement of cash flows both internally as managers, but they're also used externally by lenders, potential investors, because banks want to know that we've got enough cash flow coming in to meet the loan payments that might be coming due. Investors want to know, well, is this company in a position to pay us a dividend? They want to know about the ability to rely on cash flow from earnings. The statement of cash flows is divided into three sections. The top section is cash flows related to operating activities. And I'm going to talk a lot more about these individually, but this is just the overview. Then we have cash flow from investing and cash flow from financing. So as I said, the statement of cash flows is its own separate statement and is done in that particular order, which is operating, investing, and financing. And then this tells us at the end the change in cash. We look at the cash then from the beginning of our accounting period, the cash at the end of the accounting period, and the difference between the beginning and the ending should equal that change in cash. So another way to look at this is you've got your change in cash, and if you add that or subtract that to the cash at the beginning of the period, that should tell you what your cash is at the end of the accounting period. When we talk about sources of cash, those are what cause cash to flow into the company. When we talk about uses of cash, those are outflows of cash from the organization. And this is just a graphic that talks about the sources and uses of cash in the various categories that we separate the statement of cash flows into. And as I said, I'll be going through a lot more of this in detail starting now. Cash flow from operating activities. And there are two different ways to do this, the indirect and the direct method. We're gonna overview both of them today, but then this lesson is predominantly geared toward the indirect. Direct will come later. And so what the cash flow from operating section covers is the cash flows that really are, like it says, are related to our actual operations, what we're paying for and receiving in terms of the activities that are what the business does. And I'm going to just stop this. This is a brief example of the direct method, which we will get into in a different lesson. But the difference between the direct and the indirect method only impacts the operating section of the statement of cash flows. The investing and the financing section are the same, whether we're using the indirect or the direct method. So with the direct method, we look at cash received from customers, cash that was used to pay for merchandise, operating expenses, interest, income taxes, and then that gives us our net cash flow from operating activities. Most students find the direct method a little bit more complicated than the indirect method, which we'll talk about in a minute, but I wanted you to be able to just compare and contrast these two methods. So you may be saying, well, if the indirect method is easier, why are we even bothering to talk about the direct method? And it's because while they're both appropriate uses under GAAP, the direct method is the preferred approach. And now we get to the indirect method. Now, the direct method started from cash received from customers. The indirect method starts at net income. So we've got our revenue minus all our expenses. That gets us to our net income. So we're starting at net income. Then from net income, we're going to make certain adjustments, which again, we'll talk a lot more about later, that get us to that net cash flow from operating activities. So the adjustments that we're going to make are based on events that are non-cash items, such as depreciation or gains and losses on the sale of fixed assets. One of the primary advantages is that it is generally simpler to do, as you will see shortly. We're going to move down to cash flow from investing. This is the section that comes after the operating section, and this section is the same whether it's the direct or the indirect method. We will start with cash flows from investing and then subtract cash flows used in investing, and that gets us our net cash flow from investing. What kinds of things appear in the investing section? When we are buying or selling fixed assets, that may seem like something we do as part of our operations, but it's really more of a long-term investment in assets. And so that's how we treat them, as though they're investments and they belong in the investing section rather than the operating section. Similarly, any investments we actually do make, if the company is buying and selling things as an investment, we're going to report the cash flow from that activity in the investment section. Then we get to financing, and this is the inflows and outflows that are related to long-term debt. So again, financing is long-term debt. Investing, we talk about ins and outs from the sale or acquisition of investments and long-term assets. Financing is where we deal with debt of a long-term nature. We also look at stockholders' equity in that section as well. So things that you're going to see from in the financing section include cash that we pay out on dividends, if we are purchasing back our treasury stock, if we take out a loan and we get money for the bank, you go to the bank, you get a loan, they give you money. That money doesn't go into our operating section. That's not revenue from operating. That is income, or I shouldn't even say income, that is cash flow from financing. We took out a loan, we got loan proceeds. Now, sometimes we have investing activities that don't actually involve cash flow, and we're going to note those in our statement of cash flows, even though they are not a cash type transaction. If we had long-term debt, if we had bonds and we were going to, instead of paying our bondholders back, we're going to issue them stock instead. That would happen in the financing section. Note that it's not investing because we're not the one doing the investing. Somebody's investing in us, so it's in the financing section. And when we issue that stock and retire debt, no money changes hands, but we still want to acknowledge that that transaction occurred, so it will show up separately. Now, while we would report on our income statement, earnings per share. We would not report cash flow per share. This would potentially create a misperception that this was money that might actually be going to shareholders, so we don't report cash flow per share. So now we're down to the nitty-gritty of the indirect method, and I'm actually going to stop here and move on to the next video.